Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here's your weekly technical analysis of Chicago wheat and corn. Chicago wheat. Looking at this daily chart, I realize that there's an awful lot of information here, and it may be clouding the picture because of it. Nevertheless, I will endeavour to make some sense of it. The market has recently been wrestling with two key supports, one of which is actually unique. They are the gap from July 2021 between 657.5 to 659.5, which after weeks of trying low were finally filled, and a little higher up the 50% absolute Fibonacci line at 682. This was why prices kept making some bullish and bearish and vice versa moves. Additionally, 2 weeks ago, prices finally achieved target X at 609, the target for the early November last year to early May bearish halfway hesitation. This was a target I laid out some weeks ago. Now, my fresh view of this market has highlighted two patterns that are currently significant to what is going on, both bearish, and a possible third that may soon influence what is going on. The first and highlighted in dark blue is the early November 2022 to February 2023 bearish Andrews pitchfork. The market has mainly been between the upper time above, currently at 643, and the middle time below, currently 579, though the upper time has been breached on a couple of occasions. This has been especially evident when the additional overhead pressure of the declining short medium moving average, currently at 675, separated from the upper time back in late March. This separation prompted me to draw a second, newer bearish pattern, not a shallower bearish shift pitchfork for the same move as the Andrews, not yet though I have not ruled out finessing this out at some later date. But for the moment, this new pattern is a bear channel, currently 584 to 672, and that's for the February to date action. This is especially significant given how the upper bear channel line has been in lockstep with the declining short medium moving average since late March. Needless to say, their combined bearish pressure is greater than each individually. Finally, the third pattern is last week's weekly key reversal down. Now, for a while it looked like it was not going to make it and would end up with a lesser outside week, but at the end we finished with a weekly key reversal down. Chicago corn. There are quite a few recent key features here, though the obvious one, and what turns out to be the result of some of the actions of the other features, has been the huge changing gap lower move at the end of the week before last. This move down was led to by earlier bearish patterns and actions, notably the true break below in late April of the purple lower time, currently at 623, of the September 2021 to July 2022 bullish shift pitchfork. This pitchfork had until March this year never been tested on the downside, but the middle time above, currently off the top of my daily chart, had managed to cap the market back in late April and October of last year. Hence, as I said 7 weeks ago, it deserved some respect. It had earlier held up the market and stymied previous opportunities to reach the potential big bear flag target in the 490 zone from the potential February 2022 to date bear flag. However, 3 weeks ago, the breach of the lower purple time was also a weekly key reversal down, and more importantly, also a monthly key reversal down for April at the same time. This was finally enough to set prices moving lower. The gapping lower action went straight through the 50% Fibonacci line, the April 2020 to April 2022 move at 567, the July 2013 high at 564, the 2022 low at 562, the combination of the 2014 high and the 61.8% absolute Fibonacci line at 525, and even the October 2021 low at 516. This showed the effective vehemence of the move down. There was only congestion between 502 to 491, with the 2021 low at 498 within that finally seemingly halted the decline. So what next? Well, there is some form in the market holding in this region from the 2021 low at 498, which is backed up on the longer term charts with a slowly rising 5-year moving average, also at 498 right now. But we'll have to see how good these areas are. Otherwise, we have congestion at 469 to 465 below, and at 449, 444, and 436 to 410. The next big support is the 50% absolute Fibonacci line, and that's at 424, and that's a big move to swallow, quite a lot to swallow in one go. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.